Thank you for joining us. We're going to be going through our first of our series for the Wealth Building Strategies workshops. This first topic is called Investing Fundamentals. You all good? Okay. Appreciate you joining us today. I'm going to be starting the first of our series in the Wealth Building Strategies workshops called Investing Fundamentals. We're going to be sharing with you some of the same principles and investing concepts that we do in our own business, where we've structured over $1 billion in projects, roughly over 60 different investment transactions in our own business, and we're going to break that down for you, how you can use that for your own individual investing strategies. The purpose of these workshops is to teach like-minded individuals financial literacy and provide a central training location for investors and business owners interested in building wealth. Just a little bit about DMI. DMI is a privately held equity investment company which provides investors with a relationship-driven, trustworthy, and profitable partner who implements alternative strategies for growing wealth. We build lifelong relationships with our clients by being transparent about our diverse portfolio and by using a disciplined, research-focused approach with the objective to produce consistent above-market returns. Just brief background on myself. I'm the president and founder of DMI. Been a national public speaker for many years, teaching some of the concepts we'll be sharing with you through the wealth building strategies. As I said, I've been personally involved in having the opportunity to work with some quality operators with a variety of different types of projects in structuring over $1 billion in transactions from 2008 to present. Pretty comprehensive project mix. We've done a lot of multifamily. That's probably what we've done the most of. But we've also done many other types of real estate projects, as well as some business expansion opportunities as well. So the first thing that's vital for everybody is to know your financials. And a lot of people do what I call haphazardly investing. They just simply look at an investment opportunity, somebody gives them a hot stock tip, and they just put their money in without really, understanding what the investment is or how it impacts themselves, without any real strategy of any kind to follow. And so it's important that you look at your financial statement. And so there's an income statement and a balance sheet. Your income statement is basically all your sources of income. I've worked with thousands of investors over the years, talked in large groups, and one of the biggest risks that I've seen in investors that I've worked with is in your income column here, that the only source of income is earned income from your job, your business, or what have you. The problem is if you only have one source of income and that source of income, goes away, people start losing their cars, their homes, and those types of things. And so you want to have as many different sources of income as possible. In fact, one of our workshops is on multiple streams of income, which we'll get into later. So this is just your earned income from your job or your business, passive income, real estate, businesses, portfolio, stocks, bonds, mutual funds, that type of thing. Your expenses are going to be your taxes, mortgage, credit card, boat payment, those types of things. So your income minus your expenses is the available capital that you have to be able to invest with. So if you're if you have more expenses than you do income, obviously you don't have the capital to invest, and you probably need to reduce some of your costs. And then your taxes. Obviously, taxes is the largest expense that you have. The key is to know the difference between W-2 taxation, business taxation, and real estate taxation. This is important so that you can understand what strategies make sense based on the kind of tax that you pay, where you should do that type of investment at, which we'll get into here in just a little bit. The second thing is your balance sheet, and this is your assets and liabilities. So assets feed you, liabilities eat you. So liabilities take money out of your pocket where assets put money into your pocket. So for example, a lot of people think their home their home is an asset. Your personal residence, even if you pay it off, you're still paying property taxes, you have insurance costs, you have cost to live there, mow the yard, clean the pool. That home that you have is taking money out of your pocket every single month. There are actually strategies you can use to turn your personal residence into an income-producing asset, which we'll get into in a later topic. But basically, your assets are things of value: stocks, bonds, mutual funds, real estate, raw land, business ownership, anything that has a value. Liabilities are things that, in some cases, you use to purchase assets with. So that would be good debt, but a lot of times they're simply expenses that you're creating for yourself. That also, if you are applying for loans, bankers look at these types of things. So if you have a mortgage on your personal residence, that's a home mortgage, bankers and lenders look at loans on investment property differently than they do your own personal residence. Also, this is going to be things like credit cards, car payments, boat payments, other kinds of loans. So your assets minus your liabilities equals your net worth. So you want to buy assets that produce income. So for example, if you purchased an investment real estate property, this is an asset. You might have a liability on there, which is your mortgage. However, if that asset is producing income in excess of the cost of your mortgage, that creates cash flow and it adds another source of income in your income column we were talking about previously. And as long as you're not simultaneously increasing your expenses, your income, you want to continue to grow, which gives you more capital to be able to buy more income-producing assets to build your wealth. So this is what I call the wealth strategy. Wealth is created by owning assets that produce income or gains to buy more assets that produce more income. So let's just take an apartment complex. You're the owner of the apartment complex. You have renters that rent from you. The rent to the apartment, to the tenant in your apartment, is a liability on their financial statement. For you, it's an asset. So they're paying you rent, which is generating income to you, which also increases the value of your asset, and that gets passed on to the people that are renting from you. So this is just one example. There are others, but the more income-producing assets that you can accumulate, the greater your assets become, and also simultaneously your income. So what does the general public invest in? This is another thing that I've just seen working with all the investors that I've had a chance to talk with and sit down. So in addition to really having, too few sources of income, it's also where are they taking and placing their hard-earned money. And in the mainstream investment vehicles out there today, the majority of them are associated with and attached to the stock market. So let's talk about the stock market for a minute. We're going to go through some principles here in a moment, and some really easy to remember strategies and concepts. I started teaching my children when they were 6, 7, 8 years old. That's easy for anybody at any age to understand. And then you can look at it and evaluate an investment and see if they fall under one of these categories to understand if you're actually doing an investment or if in fact you are speculating. There are seasoned, trained, skilled stock market investors that can make money whether the market's going up, going down, or going sideways. They also know how to use leverage. This takes time, training, and investment of capital to learn some of these things, no different than if you're a seasoned, skilled real estate investor. And so the problem with investing in the stock market is not so much the stock market itself, it's how you go about doing it. So one of the things to consider is what happens when the stock market goes up 50% one year and then goes down 50% the next. Some people might think you broke even, but in fact, it's much worse than that. So I'll give you an example. Say you have $1,000 and it gains 50%. That's $1,500. You made a $500 gain. Then the stock market takes a loss of 50%. So what actually happens is you made a gain of $500, but you had a loss of $750. That's a 25% capital loss. A lot of times your financial advisors and planners will, make you feel comfortable by telling you it's just a paper loss. If you had a family member that was ill, you had to access cash. The nice thing is your money is liquid and you can convert it to cash, but at whatever value your portfolio that's in the market is at, if you liquidated it and converted it to cash, that is what it's worth. So it's not a paper loss, it's an actual loss. The only way that it's a paper loss is if you just stay in the market, but not everybody is going to do that. Sometimes you might ride the market all the way down and you just continue losing more and more of your hard-earned money and your wealth. So what I'm going to be teaching you today is how to safely and consistently earn double-digit returns and build long-term cash flow. So this is kind of your traditional investment strategies that are, presented to the general public. I say change with the times or die with the dinosaurs. So a lot of the financial planning and all of these things were really based on an industrial age mentality. However, we are not in an industrial age world anymore. We're in the information age. And so the value of stocks and mutual funds and things of that nature in the past used to actually have to do with the fundamentals of the company, more so than the speed in which the buying and selling activity causes the market to bounce around so heavily. And so some of these concepts haven't changed, and the training and education of the financial advisors and your mainstream custodians like Merrill Lynch, Charles Schwab, Smith Barney, Edward Jones, and so on, the planners and the advisors are only actually allowed to talk to you about the kinds of investment products that they have available to sell you. So even though you might say you're looking for tax advantages, I'm looking to create cash flow, I also want to build equity, I want something that's going to help me offset expenses and those types of things. And what that advisor needs to be telling you is you need to look at investing into some rental property or apartment complexes or things of that nature, but they are not able to offer you that. So that advisor, even though he himself might do it or can advise it, they're actually not even supposed to talk to you about it. So what's being recommended is savings, CDs, stocks, bonds, mutual funds, real estate investment trusts, which is basically a real estate mutual fund that prevents you from getting the tax advantages from direct ownership in real estate. So you have tax advantage income going in through rental income from the types of properties that the real estate investment trust owns. And then the income, if it's paid out as a dividend, is actually taxed at a different rate, which we'll talk about in a minute. Unit investment trust, variable life insurance product. So life insurance is supposed to provide the G word for your investment portfolio, which is guarantees. There are very few investments that have guarantees. A CD is a guaranteed investment. Your money is guaranteed. You're also guaranteed that you're not going to make any kind of return on your money because CDs don't pay much of an interest rate to the CD owner. So when you take a life insurance product that's designed to provide you guarantees and you mix it with the stock market in the form of variable products, whether it's a variable life insurance product or if it's a variable annuity, these products are tied to mutual funds that are in the stock market. Why do insurance companies like to do this? Because insurance companies don't want to pay out on their death benefit or their annuity benefit. And when people see the values of their cash value in their life insurance or their annuity going down and up and all over the place, what do they wind up doing? They wind up canceling their life insurance. They wind up exiting out of their annuity for surrender charges and fees. And guess what? The insurance companies don't have to pay out on those because you no longer own them because you saw the value going down. So if you're going to own insurance products, you really don't want to have a variable product. You want to have something that truly provides you a guarantee. We have a workshop strictly on life insurance and annuities for a later time. I won't focus on that here today. So this is kind of an old slide, but it's just for the concept of understanding from what happened when the industrial age ended and the information age began. And that was basically when the dot-com boom hit. Any monkey could throw a dart at any stock or mutual fund you wanted. You can make 100, 200, 300%. I was one of those monkeys myself. I thought I was doing great. My financial advisor was a hero. And then, next thing you know, it kept going up. I literally had, in some cases, 400+% gains on my money. And then all of a sudden, it started to go down. And I'm calling my financial advisor saying, hey, we've made pretty good money. I'm starting to see it's dropping quite a bit. Why don't we go ahead and just sell and pull money off the table? And I was pretty young at the time. And this particular advisor, who I'm still friends with today, is in his 80s. He advised me to, just let's hold the course. It'll come back. Well, he kept telling me that as you see that line there that's starting to go down, continue to go down. And I finally just called him and told him, sell all my stuff, convert me back to cash. Instead of being at a 400% gain like I wound up being at a 200% gain because I listened to him instead of listening to my gut instinct. So from that point forward, if you're a mutual fund buyer, and by the way, you can invest in the stock market. You cannot invest in a mutual fund. Mutual funds are pure speculation. The only way you make money on a mutual fund is by the value going up. And I'm going to share with you just some litmus tests you can put on any investment that you're considering to see if it's really an investment or are you in fact just speculating with your money. So what is a mutual fund? A mutual fund is nothing more than a packaged group of stocks. There's fund management fees, there's money manager fees, there's fees charged regardless of the profit or loss. So let me give you an example on the only way I would personally invest in a mutual fund. The fund manager makes money no matter whether the mutual fund is going up, down, or sideways. It's simply they make more when it's up. They make less when it's down. However, they are guaranteed to make money as long as that mutual fund is open. If I was going to invest in a mutual fund, as an investor, I would invest in the fund management company because I would be guaranteed to make money regardless of how the mutual fund is performing. So investing in the fund manager is an investment. Investing in the mutual fund is speculation. You cannot control whether you make money, lose money, or not by buying a mutual fund. You're not investing in a mutual fund. You're making a purchase and you're speculating and hoping that the mutual fund goes up. You have no idea at what price point. There's probably 20 stocks in your mutual fund and you have no idea what price point each one of those individual stocks was purchased at the time you put your money in. If you're going to invest in the stock market, buy those individual stocks when they're on sale one by one, free of fund management fees, money manager fees, and you're able to mitigate and reduce the risk that the stock will go down. If Walmart's trading at $50 a share and you see it goes down to 25, I don't think Walmart's going anywhere, and it doesn't take a rocket scientist to figure out you may want to go ahead and buy you some Walmart stock, because if the 52-week trading average is $50 a share and it's down at 25 for some weird reason, go ahead and buy us some shares. It's a pretty safe bet that at some point it'll climb back up there, but you certainly don't want to buy it at 50 and then it goes down to 25, and then you're going to have a capital loss. There's just no way to determine the price of each individual stock at the time that you purchase. So the buy, hold, and pray strategy is an industrial age mentality. That does not work in today's investment arena. So understanding the basics. There's nothing complicated about what I'm about to share with you. Very simple. And again, I started teaching my kids this when they were very young, and they still understand it in their teens today. And so there's nothing hard about what I'm about to share with you, but you must have a strong foundation for investing if you want to be successful. I love Warren Buffett. Warren Buffett says diversification are for people that don't know what they're doing. However, some people think that if their financial advisor has them invested in stocks, bonds, mutual funds, variable insurance products, unit investment trusts, real estate investment trusts, that they're diversified. In fact, they are in one asset class, although they're spread out all over that asset class, and it's called the stock market. So again, nothing wrong with the stock market if you have the experience and knowledge to succeed and make money, whether the market's going up, down, or sideways. But just having your money spread out in a bunch of different products, all associated primarily with mutual funds or other types of funds, is not being diversified. There are other asset classes to consider. Sitting on cash. A lot of people, think if they're sitting on cash, they're losing money. Sitting on cash is opportunity waiting to knock on the door. If you don't have the liquidity and the cash that you know isn't going to go down, when an opportunity comes up, you're going to miss on some good quality opportunities. Let's look at what just happened with COVID. I can tell you a lot of people got put in real check on how liquid they were, because when you stop being able to go to work and people are losing their jobs, having a hard time paying their bills, if you weren't sitting on a pretty decent amount of cash, you were concerned. So it's important that you have those reserves. You can invest in businesses. There's many different ways to do that besides through the stock market. Real estate, there's a wide variety of types of real estate we'll cover in other presentations and workshops, and insurance products, and there's other alternative investments. Do you need to be spread out across every different kind of asset class? Absolutely not. I personally do not own one stock, bond, or mutual fund, and the reason is that I'm more experienced in real estate, and unless I'm going to spend the time, the energy, and the money to become a seasoned, skilled stock market investor, it's not necessary for me to know how to invest in the stock market. I understand the concepts, but that's not where my expertise is. So again, going back and quoting Warren Buffett, there's, diversification for people that don't know what they're doing. You don't have to be spread out across every asset class, but you better be knowledgeable in the asset class you're choosing to invest your money in, because nobody cares about your money more than you do. So there's different types of income and taxation. Some of these slides may be, last year or outdated, so if there's an inconsistency here, just forgive me, but the concept is the same. So there's different kinds of income. So based on where you're getting your income and what type of income the investment is generated may also dictate where you may want to consider doing that investment. So earned income is just based on how much you pay is based on how much you earn. If you're making $30,000 a year, you're going to be in the lower tax bracket. And if you're making $400,000 a year, you're going to be in the highest tax bracket. Passive income from real estate is taxed at a flat rate. It was 20%. I don't know if that changed for 2021. Taxed at a flat rate. Let's just use 20%. But in addition to, and this is regardless, let's say you're in a 35, 40% tax bracket for earned income, and you own real estate and it's kicking out income to you, you're not being taxed at your earned income tax rate. It's a flat rate of 20%. Plus, in addition to that, you're getting depreciation deductions each year. And so you may actually zero out the taxes you pay from real estate because of that. Dividend income is taxed at your earned income tax rate. So remember what we were talking about earlier. You buy a real estate investment trust and you have tax advantage income passive income and depreciation deductions going into the REIT, they don't then get passed on back to you unless you had direct ownership in the property. It comes out in the form of a dividend income, and you don't get the benefit of the tax advantages. You're just adding to your earned income. Is there anything wrong with investing in a REIT? No. But based on your tax bracket, you may want to consider investing in a REIT that kicks out dividends inside of a Roth IRA versus adding to your earned income tax losses outside of a retirement plan. Portfolio income could be short or could be long. Here's another thing a lot of people don't realize when they buy mutual funds. If you're buying stocks and you're a stock market investor, you're controlling the frequency in which you buy and sell. If you're somebody who's day trading, or you're going to do a lot of short-term transactions and take profits off the table, you may again want to consider doing those things inside of a retirement plan, a self-directed, IRA or a Roth, because you're going to protect your tax losses inside of that tax advantage vehicle. And so if you own a mutual fund, for example, you might have somebody that is managing that fund, and they decide that they want to sell one company and purchase another one in less than a 12-month period of time. You don't know that they just created a short-term capital gain for you. However, at the end of the year, when you get your mutual fund statement and you hand that off to your tax advisor, most people don't look at their statements, by the way. They just hand it off to their tax advisor. The tax advisor will then take that statement, and he's going to book whether there's any buying and selling activity. And if anything was sold in less than a year, you're generating short-term capital gain to yourself. Residual income. I'll say you build up a network marketing company. At first, that income is active. And then once it develops to a point, it becomes passive. So residual income is active, then passive. Royalty income is passive. Interest income is your earned income tax rate. So we do a lot of hard money lending. We have a lot of investors that will do loans. And so if they're doing those loans outside of a retirement plan and they're charging 12%, 14%, but they're in, say, a 35 or 40% tax bracket, the interest, even though they're getting a high interest on their money, they are also having a earnings loss from taxes because it's taxed at their earned income tax rate. If they had enough capital inside of a Roth IRA, for example, they charge that 12% or 14%, they're going to keep 100% of it. Because the vehicle itself protects from the loss. Short-term capital gain, it's your earned income. So if, let's say you have a job and you're on the border of a 28% to a 35% tax bracket, just for example, and then you flipped a single-family home and you generated a $50,000 short-term capital gain. So not only is that short-term, but you also could have just bumped yourself up into the next tax bracket, further not only losing profits on the fix and flip, but you also now just lost the difference on everything you had earned previously because your whole tax bracket changed. So you got to pay attention to things like that. Long-term capital gain, unless that changed, it was 15%. Unless it changed for 2021, is at 15%. So not bad. You certainly would prefer to have a long-term capital gain. So I'll give you an example, just using some common sense and some strategies. We will invest in residential home development with a builder we've been working with for many, many years. It generally takes, from the time of investment to the time that the investment matures and the home is built and sold off, it takes about a year. Well, we've had some that have taken less than a year. And maybe 10 months, and we'll stretch the closing date out till past 365 days. So instead of having a short-term capital gain, we turned it into a long-term capital gain and didn't lose quite as much money. So just some things to pay attention to. If we hadn't been paying attention to that, we would have lost 35 or 40% of our gains to tax instead of 15, just because we were in a hurry to get the profits distributed more quickly. And go ahead and close fast. And then life insurance, there's some interesting strategies for life insurance and real estate loans. You can actually borrow money out of your life insurance policy without reducing the earnings value, and a life insurance policy loan is tax-free. So you can borrow money tax-free. You could actually use that money to do other investments with, pay the money back if you chose to, but you can distribute money to yourself out of a life insurance policy while you're alive. There's actually more living benefits to life insurance than there is with the death benefit, but not everybody completely understands their insurance policy. Same thing with real estate. So if you go in and you refinance a property, we do this on multifamily all the time. We have a property here in Dallas. The property was refinanced after about 3 years. I was an investor in it. We had a bunch of our investors in it. That refinance returned 100% of the investor's money. We still own it. That was a return of capital. However, we're about to go in and refinance that property again or do a supplemental loan, which means that every investor in the project is going to get a loan proceeds distribution that will be relatively substantial. That distribution, once it goes to the investors, will not be a taxable event to them because the source of the capital came from loan proceeds. So some interesting things you can do with real estate with regard to that. So I'm going to get into some of these strategies. Again, these are very simple, but please pay attention. So there's 4 primary investment strategies that you can do. You can invest for cash flow, capital gain, tax advantages, or asset protection. So let me give you an example. Let's just take a single family residential home, and you're going to turn it into a rental property. And let's say you're going to buy it all cash, and I'm going to buy it in the name of Eric Mattingly. So Eric Mattingly individually owns a single family home that you paid all cash, which I would recommend if you do residential rental, you buy all cash and don't have any debt. But it's in my name. So let's look at the strategies being used in this situation. So with a renter in there, it produces cash flow. If I sell it at a later date, it can produce a capital gain. And the income that's being generated is rental income, which is tax advantage, and I get depreciation deductions. But is it also providing asset protection? The answer would be no. Why is that? Because I took it out in my own personal name. Now, I do want to be clear that you don't have to have every investment that you do be all 4 of these strategies. Just you need to understand what strategy you're investing in before you make an investment. If you have a cash flow strategy and investment parameters, you don't go buy a raw piece of land that's going to sit there for 10 years. It doesn't fit your investment objectives. So if I was to do this single family home rental I just gave an example on, and I held it inside of my family limited partnership or an LLC, it then also would give me asset protection. And there's many other examples, but again, I'm just giving you one. Then there's investment tax treatment. You're going to invest where the investment is taxable or tax deferred or tax free. So taxable investments are done outside of a retirement plan. The investment itself, let's say you buy tax-free municipal bonds in your name individually, well, then you just purchased a tax-free investment. If there's no reason to buy tax-free municipal bonds inside of a retirement plan because it's already tax-free. There's no advantage to you, and you just consumed usable cash in a tax-advantaged vehicle to do an investment that already had that tax advantage. So it doesn't make any sense. It's again why you got to have some strategies, some basic fundamental concepts when you're looking at doing investments. Tax deferred is basically retirement plans. So you have, IRA, 401k, Roth, Keogh, SEP, 401k Roths, healthcare savings accounts, and the list goes on. Inside of these vehicles, you're able to make gains without paying tax. Now, if it's a Roth, IRA or 401k Roth, it goes in as after-tax dollars and comes out tax-free after you're 59 and a half. Also with a Roth, once you've owned it for 5 years, you can actually start accessing and taking your money out that you contributed. After 5 years, you couldn't start distributing profits, though, without a tax liability until you're 59 and a half. So there's some real advantages to a Roth IRA, and then taxable is anything outside of that. So let's just look at a couple of examples. Let's say I'm going to flip a house, and I have money. Let's say I have $300,000 inside of my IRA, whether it be a Roth or a traditional, and I have $300,000 outside of there. Where does it make the most sense to do that fix and flip? Well, some people would just automatically say, well, okay, if you fix and flip a home, it's going to generate a short-term capital gain, which is going to cause some of the things we were talking about earlier. I might wind up paying a lot in tax. I might wind up bumping myself up into another tax bracket. But the answer is it depends on you. So let's say my investment strategy was to create cash flow and usable income for myself. If I invested that money inside of a tax-deferred vehicle like an IRA, but I wanted to use the money to purchase something for myself, pay expenses, that kind of thing, I can't touch that money until I'm 59 and a half if I don't want penalties. So even though you might pay more tax, based on your strategy you're looking at for yourself, you might decide to go and invest that money outside of your IRA and go ahead and pay the tax because you wanted to use the profits for whatever it is. One of the things we used to teach some of our students, we had a real estate investment education company, is as a simple concept is to use transactional investing strategies to purchase income producing assets. This is a perfect example to define what I'm sharing with you right now. So let's say, for example, I want to accumulate a rental portfolio, but I don't have a lot of money. I might work with a hard money lender and a private investor so I can fix or flip a home. And let's say I generate $100,000 of profit and I pay off the hard money lender and I do a deal split with the private investor and give him 50% of the profits, and now I have $50,000. Yes, short-term capital gain to me. However, if I do that 2 times, I now have $100,000, and I can turn around and go buy a $70,000 house that generates $1,000 a month of income and have $30,000 left over to pay my tax, and now I just created a ongoing passive cash flow that is tax advantage after I used this transactional strategy, even though I wound up paying more in tax. So just some things to think about as far as your tax treatment goes, of what you're going to do and where. What are the 2 biggest robbers of our wealth? There's investment loss and there's taxes. And so you've got to really think about this with what you're investing and where you're investing from. So let me give you an example. You may or may not have heard of doing a Roth conversion. Back in 2010, they allowed anybody at any income level to move money out of a traditional retirement plan into a Roth IRA. Prior to that, there were income restrictions on who could contribute to a Roth or who could convert to a Roth. And if I remember, I think if you made over $160,000 a year, you couldn't do it. In 2010, they changed that. In addition to that, they also allowed you, because when you do that, you create a taxable event, meaning that if I take $100,000 from my traditional and I roll it over into a Roth IRA and I'm in a 35% tax bracket, I just created a $35,000 taxable event to myself. The cool thing about doing the rollover is, even though you just did that, unlike a actual capital loss inside of your retirement plan, you could actually roll over the entire $100,000 and pay the $35,000 in taxes with cash other than what was in the IRA. But in 2010, they allowed you to stretch those tax payments over a 2-year period of time. And then after that, you could still convert, but you were going to have it due. The other thing is, if you have deductions and other things that produce tax deductions, you might offset some of that. And so what happens is we've seen people that, and there's some real strategies behind this we'll go into in our IRA workshop, Wealth Building Strategy workshop. We have a beginning and an advanced version, but I'm just going to give you an example of one of the most common mistakes. Let's say I own a bunch of mutual funds and they're inside of my traditional retirement plan. And then I get the idea, or I'm told, you may want to go ahead and convert this over to a Roth. And let's say it's $100,000 in mutual funds. And then I roll it over to the Roth IRA. I just created a tax loss by doing that, but maybe not a bad idea if I'm able to, if that mutual fund happens to go back up. But remember what we were sharing with you earlier, when you have a capital loss, you have to earn more than the capital loss to get back to square one. Then what happens is you rolled it over, now you're in your tax advantage account and you thought you made a really good decision, and then all of a sudden the stock market goes down. Now you created a tax loss and you just had an investment loss. So your $100,000 that's now worth 70 when you rolled it over, then you have a 50% loss, and now you're at a catastrophic loss at that point. So you got to really think about what you're doing, where you're doing it, and how you're doing it. There's 3 rules to investing. This is the litmus test of if you're doing an investment. When you do an investment, you can either buy it at a discount, you need to be able to create value, and you need to be able to protect your principal. So let's just look at a couple of examples. Let's say I'm going to purchase a $100,000 single family home that can generate $1,000 a month. If it's worth $100 and I pay $100, did I buy it at a discount? No. If I bought it all cash, I'm still relatively safe. Real estate doesn't fluctuate up and down quite as much as the stock market, but you don't want to be a retail buyer. So I wouldn't buy a $100,000 house, and I don't, unless I can buy it for $70,000 or less. So that goes on all the time. How might I do that? Well, I might actually buy it for $50,000 because it's tore up, in disrepair, and needs to be fixed up. And so I buy it for $50. I invest $20 in it, repairing it. Once I've repaired it, the after repaired value is $100,000, but I only have $70 in it. Now I have bought the investment at a discount. I'm able to protect my principal, because even if the value of the real estate goes down, it's going to have to go down quite a bit to have me actually have a capital loss, because I bought it for 30% below what it's actually worth. And I'm able to create value because of the real estate also has the ability to appreciate. And let's look at another investment option. So I'm from Dallas, and I'll just use an intersection here around town. If you're from Dallas, you'll know where I'm talking about. And you go to 121 and the tollway on the corner there, and that's a really busy intersection. And let's say you could find say a 20-acre piece of land. I'm just throwing this out here. Say a 20-acre piece of land, and you could buy it for, and it's worth $1 million. So the land is actually worth $1 million. Would you pay $1.5 or $2 million for a piece of land that's only worth $1 million? Generally, when I ask that question in a big room full of people, everybody is raising their hand and they're saying, no, you wouldn't do that. Well, in fact, that depends. So let's just use real estate as an example. If you're going to do an acquisition on a piece of real estate, you want to buy at a discount. If you're going to do development, you're creating value where it didn't exist before based on your skill set. So if I was trying to flip that piece of land, I would be an idiot to pay $2 million if it's only worth $1 million, because I wouldn't be able to sell it and flip it. However, if I'm a developer for, say, IKEA, which is what's sitting on that corner, I would pay $2 million, $3 million, or $5 million for a piece of land that wasn't for sale, because everything's for sale if the price is right. That wasn't for sale to be able to develop and add value by putting an IKEA on that corner. So in that case, I still was able to apply the investment strategy, and it might seem on the surface like that's not a good idea, but it depends on your knowledge and your ability to justify why you might pay more for something than it's worth based on what you're going to do with it. And with that, I want to thank everyone for joining us. We will be putting out some more of our wealth building strategies workshops that hopefully you will find value. If you are interested in learning more about DMI, want to see all the projects that we've been involved in and our track record, you can go to our website, www.dmi.holdings.com. If you'd like more information on looking at or getting an opportunity to review any projects that we're doing, or just like to ask some questions, just email us at invest@dmi-mgt.com. And again, my name is Eric Mattingly, and I want to thank you for joining us today. Thank you.